Hello, and welcome to Kathmere Capital Management's second quarter 2018 quarterly market review webinar. I'm Nick Ryder, the Chief Investment Officer at Kathmere. Today's webinar is part of our quarterly market review series that reviews the performance of global capital markets, shares our insights into the drivers of performance, and provides our perspective and commentary on topical issues affecting long-term investors. We'll start out today's session by reviewing the performance of global markets, and then we'll move into a selection of more topical and thematic issues. First slide here, it provides a good summary of global asset class performance as of June 30th, 2018. I'll focus primarily my remarks on the green bars running from left to right on the page, which reflect the performance of the asset classes during the second quarter of the year. The gray bars represent performance for the first 6 months of 2018, and the gray diamonds across the screen represent 1 year performance as of June 30th. We can look and overall just see that performance was relatively mixed across the asset classes across the second quarter, this in spite of the continued economic expansion, which now is into its 10th calendar year. You see U.S. stocks there up about 4% for the quarter, contrasting that with non-U.S. stocks, which were down nearly 3%. If we look at slightly longer term results, the 6-month performance, U.S. stocks just up slightly more than 3, with international down slightly more than 3. The 1 year performance still looks relatively strong, though, with U.S. up about 15 and international up about 8. Further across the page, you can see that bonds best characterized essentially as flat during the quarter. U.S. bonds with some slight losses owing to a modestly rising interest rate environment. Non-U.S. bonds, slightly positive returns. Rates were more mixed across major developed markets around the world. Moving further to the right, you can see returns for two prominent categories of real assets, so global real estate, which encompasses, as the name suggests, both U.S. and non-U.S. real estate securities. Modestly positive 3.4% return during the second quarter, offsetting some losses that occurred during the first quarter, bringing the year-to-date total back to about even. And then commodities just to the right, essentially breaking even on the quarter as well as on the year-to-date period. Really tell two stories there within the commodity markets, with energy complex, so think oils and gasoline, doing quite well, and contrasting that with some of your agricultural commodities such as grain, soybeans, performing quite poorly, as many of those have been caught up in the crossfire of the global trade concerns. And then cash all the way to the right, incrementally positive returns. Good to see those returns now into positive territory on a consistent basis, given where we stand with this cycle in terms of monetary policy, with the Fed have now having risen rates for the 7th time this cycle, and short-term rates currently standing in the 1.75 to 2% range. The next slide here is one we like to include in presentations like this for two main reasons. One is it shows the route taken to the destination. So on a previous slide, whereas you're looking at just a full period performance, so thinking of A to B, what that has a tendency to do is it just masks the ride taken to get there. So for instance, if we focus at just the year-to-date period, and so this covers the MSCI All Country World Index, which is just global stocks, so both U.S. as well as foreign stocks. And if we focus from the middle portion of the page to the right, which covers the first 6 months of 2018, you can see that whereas the overall period return was essentially flat, it was about a loss of 1% on the globally diversified portfolio. But you can see a bit of volatility mass along the way. We started out the year quite well with the index up nearly 8% in the early portion of January. That was followed by a 10% decline in the market. And then since then, stocks have kind of bounced around in a relatively narrow range. The other thing I like to point out with a slide like this, and we include the headlines on here, and really the point of the headlines is they're offered not necessarily to explain returns, but to remind investors that there is a ton of noise out there, and that what we believe is the most appropriate way to invest is to view these daily events, the daily news, from a long-term perspective, and to avoid making investment decisions solely based on the news. Next few slides, starting here, we'll take a bit of a deeper dive into stock and bond performance. Similar construct to what we saw at the outset on the opening slide, rather, with the charts displaying the second quarter performance, the year-to-date performance, as well as the one-year performance. Here, that look just helps us get a bit more of a granular look into some of the different segments of the U.S. equity market here, which, as the chart on the bottom left depicts, covers about 53% of the global stock market. We already talked about total market returns all the way to the left, so I'll keep moving further to the right. And the first division or cut of the market we get is to look at the difference between large and small cap performance. You can see that for the second quarter, small caps outpacing their larger cap peers by a little bit more than 4 percentage points, a gap that's of comparable size over the year-to-date period as well as the trailing 1 year. A lot of this small cap outperformance has been attributed to small cap companies tending to be more focused just domestically, so benefiting slightly more from the tax law changes, deregulatory efforts of the current administration, and potentially slightly more insulated and less exposed to the rising concerns around tariffs and trade. Further to the right, then, we start to be able to look at how compare and contrast performance of value versus growth stocks. So focusing first on the large cap portion of the market, you can see that large cap growth stocks up 5.8% on the quarter, outpacing their value peers, which were up 1.2%. If you look particularly stark, that gap when we cover the 6-month period for the first part of the year as well as the full 1 year period, pretty significant gap, right? This is a lot of attributable to when you hear about the FANGs in the news. So Facebook, Apple, Amazon, Netflix, Google, these large tech companies that have had a really good run of late. This is driving the outperformance for growth versus value. And then further to the right, you just cut it, the value growth distinction within small caps. And interesting to just highlight their small cap value, the top performing of all the cuts we do display during the quarter, up 8.3%, outpacing small cap growth. But this does stand in contrast to the record over the last really better part of a year where small cap growth had outperformed small cap value on both the year-to-date as well as 1 year period. And before we flip, just call your attention to the bottom right-hand portion of the screen where we do show some annualized longer-term returns. First and foremost, just total stock market. Pretty impressive or healthy returns over the trailing 3, 5, and 10 years. You look at that 10-year numbers, right around in the ballpark of what that long-term historical average. The last 3 and 5 have been slightly stronger than the long-term average experience in the U.S. market. And then a few rows down, just to elaborate a bit further on the value growth split, you can see large cap value trailing large cap growth by a pretty noticeable margin over the last 3 and 5, and even to a similar extent the 10-year period, with the growth peers outperforming value by about 3 percentage points annualized. This, as many of you are all familiar, does stand in contrast to the long-term historical experience where value over extended periods of time has proven to outperform their growth peers. But we do see and have seen in the past periods of 5, 10 years where value has trailed. So it's not completely unprecedented, but it is relatively uncommon. Data typically shows that over a 10-year period, value beats growth in about 84% of the time. So this is rare to see an underperformance, but something we have seen before, particularly if you think back to the late 90s where growth was, for the better part of the entire decade, outpaced the value peers. This next slide here gives another breakdown of stocks, this time focusing on foreign stock markets. So non-U.S. developed markets account for about 35% of global stock market. Emerging markets a further 11%. Cumulatively, you see they add up to about 47%, roughly half of the global stock market that's not U.S. Excuse me. Total market number we did review earlier, down 2.4% on the quarter for the blend of developed as well as emerging. A strong U.S. dollar was really the primary driver of this. So stronger U.S. dollar makes assets held in foreign currencies worth less, and so that was a drag on returns, where many developed markets were actually positive in local currency terms for the quarter, but when added with the currency, return became negative. These things tend to be cyclical and kind of wash each other out over time. First split then, there further to the right, just look at the tale of two stories between developed and emerging markets. Developed essentially flat, emerging down nearly 8%. Emerging had been on a pretty good run leading into this year, but has been hit, somewhat by the escalating trade concerns. Currency weakness has been another part of it. Rising interest rates that have had an effect on some economies and capital flows. So a variety of different stories, but emerging market. You can see even in light of the weak, very weak second quarter, the 1 year performance, still some incremental outperformance, largely on the backs of the really strong showing from emerging in the second half of 2017. And then you look across the page further, not nearly as significant of difference between large cap versus small cap, nor value and growth as what we had seen on the U.S. market, but similar tale with particularly the value growth story with value lagging growth. And you can see that over all the time periods shown. And lastly, just towards the bottom of the page again, focusing on long-term returns, you can see the total market average annualized returns of 5.6% over 3 years, 6.5 over 5, and 3.0 over 10. Those were well shy of what we had seen in the U.S. market. If you recall, the comparable numbers for the U.S. market over the 3 year period was 11.6%. Over the 5 year, it was 13.3% per year, and over the 10.2%. So you've had some pretty extended and running underperformance here on non-U.S. stocks, really since the bull market began in March of 2009. This slide here, though, shows that there is some precedent for underperformance of this both magnitude as well as duration. What we plot on this chart here is to take the performance of international stocks, developed markets only measured by the MSCI index, on an annualized 5 year basis, and we subtract off the return of the S&P 500 for U.S. stocks, and just plot that over the time, and you can see periods where the green line is above the horizontal axis means international stocks have outperformed on the 5 year basis, and periods where the green line is below the axis means international have underperformed over the 5 year period, which is where we find ourselves today. And you can see that, again, as I mentioned out, that there is some precedent for underperformance of both this magnitude as well as duration. You've had some periods where international is heavily outperformed and others where it's significantly underperformed. What you do kind of see is that this tends to move in cycles, but what our view on this is that it's impossible to predict when these cycles will turn, but we have a pretty significant degree of conviction that they will over time, and that the story in case for diversifying beyond just U.S. borders remains intact. Last slide here, just covering performance at a high level. We focus on the bond markets. Again, similar look as we've had on a few of the other slides. At the far left, you see the U.S. and non-U.S. bond returns, which we had covered earlier, essentially flat, with non-U.S. bonds doing slightly better as interest rates around the world in developed markets tended to actually move down or were flat, where it was interest rates in the U.S. tended to move up, putting some downward pressure on bond prices and leading to those losses on the quarter. Municipal bonds slightly stronger than taxable investment-grade bonds in the U.S., most likely attributable to some technical factors relating to supply in terms of new issuance and demand during the quarter. The next two bars over, just show you a bit of a difference between the returns in short-term bonds versus longer-term bonds. So short-term bonds, their prices are less sensitive to changes in interest rates. So in an environment where interest rates went up, that less sensitivity to the changes means that short-term bond prices went down less than what happened to long-term bonds. So that's why you saw some modest outperformance. I'll give a plug here. We did recently write a commentary outlining kind of this dynamic a little bit and explaining why we're starting to see some opportunity in short-term bonds, primarily on the basis of this relationship where changes in short-term bond prices are less sensitive to changes in yields. Further across the page, then the next three sets of indexes give you a look at how credit risk was rewarded during the period. So ranging from treasury bonds to credit bonds to high yield bonds, you increase credit risk. And you can see there wasn't really a clear linear relationship during the quarter, with treasury bonds incrementally positive, investment grade credit bonds slightly negative, but high yield bonds slightly positive. So no straightforward relationship. necessarily be at play there, but you can see if you look over the 1 year period with the diamonds that credit risk was slightly rewarded as you moved lower in credit quality with Treasury bonds negative 0.6, right in line with investment grade, but high yield did outperform a touch. And then all the way to the right, we see the shorthand called TIPS, which is just short for Treasury Inflation Protected Securities. These are bonds issued by the U.S. Treasury that are that have their price and coupon payments adjust based on realized inflation. And so when the market starts to, or investors start to expect more inflation, these bonds will tend to do better than straight Treasury bonds. And that's what you saw with inflation expectations picking up a bit during the quarter. TIPS outperformed their what are called nominal counterparts there with the Treasury bonds. So 0.8% versus the 0.1% return we saw earlier on Treasuries. We'll now move into a bit more of the section of the presentation that covers some thematic issues, and we'll start with one that we've talked about a couple of times throughout the course of the year with our clients in commentaries, which was the return of volatility to the stock market in 2018. So this slide, what it does is it just looks at the daily index returns on the S&P 500 and categorizes them or counts up the amount of times the market moved up or down by 1 to 2% a day. That's the green bars. The blue bars stacked on top of them show when market moved up or down by 2 to 3% a year, and the purple then being days of up or down movements by more than 3. And if you look all the way to the right-hand side of the screen, you can see that 2017, very little volatility. We saw in total 8 days where the stock market, as measured by the S&P 500, moved up or down by 1 to 2%. You had no days where it moved by more than 2%. Contrast that with the experience of the return of volatility in the earlier part of 2018. But you can see thus far on the year-to-date basis, we've had what comes out to 28 daily moves of 1 to 2% in either direction, and an additional 6 of 2 to 3%, and then 2 days of more than 3%. And those numbers, even just through the first half of the year, are almost in line with the median or average year over the past 37 years, and we're only 6 months through. But nevertheless, so that even if you were to double the size of that, you have seen years of more volatility in the past. But nonetheless, a return to volatility in 2018 from what is really best described as the historically tranquil environment of 2017. This slide here just takes a slightly more granular look at volatility in the stock market, and we use this to make another point, which is that volatility spikes are relatively common in the market, and that's really what you can characterize the return of volatility thus far in 2018 is just a bit of a volatility spike. So this is a slightly different measure of volatility. It looks at on a rolling 50-day trading day basis, which is roughly equivalent to 2 months. It measures the average of the absolute daily percentage change. Essentially, it tells you on a given day during this trailing 2-month period, how much up or down did the market move. Think about it. If this metric gave you a reading of 1, it would say that on the average day over the last 2 months, the market moved up or down by about 1%. The long-term average going back to 1950 is 0.57, so slightly more than 0.5%. So when you start to get to 1, that's a bit more volatile than the historical average. And what you can see is, again, the aforementioned volatility spike that occurred in the first earlier part of the year that's since subsided, but we moved from, again, historically low levels of volatility through 2017 up to this spike where the metric ultimately read 1.1, so we were exchanging essentially 1.1 moves up and down daily for the course of 2 months. And during that time, as many of you recall, the stock market, the S&P 500 fell by a little bit more than 10%, entering that technical correction. But since then, in the interceding months, as we've moved forward, the volatility has kind of trailed back off. The market's resumed climbing higher, and that's where we've ended up with the year-to-date positive returns. But the broader point on this slide is to show that spikes like this are relatively common occurrences, even during an otherwise upward trending bull market. You can see if you just continue glancing further to the left on the slide, that we've had 5 separate instances just during the last 9+ years during the bull market run where volatility, this measure of volatility, has spiked to about 1 or more percent. And you've seen that during those time frames, typically volatility is associated with declines in the market at the same time, and you've seen a number of instances where the S&P 500 declined by more than 10%. But ultimately, volatility did start to subside, and the market did resume its kind of upward trajectory. So, point being that nothing about just a rise in volatility, while you do get losses in the here and now, nothing suggests that when volatility does arise that the market needs to continue to go down. This slide then will really wrap up on the volatility theme with, but it makes a highly related point, and we had talked about how we've had these 5 separate instances, now 6 separate instances during the 9.5-year bull market run where the S&P had declined by more than 10%, and it shows that market corrections, or these 10+% declines, are relatively common occurrences in stock market investing. What we show on the slide is, with the gray bars running across the screen, shows the full calendar year performance of the S&P 500 index. And what you see is that in 30 of the past 38 calendar years represented on the screen, where stocks averaged 10.1% per year, you see that in 30 of those 38 years, roughly 3 out of every 4 years, the full year return is positive. What we often show is, or what we show then in addition to that on this slide, is the red bars dropping down below the horizontal axis, which show or plot the within year decline in the market. So the largest decline within the course of the year from an intra-year high to an intra-year low. And you can see that in many of these years, the intra-year decline is quite significant and certainly in excess of 10%. So if you look across the page, you'll see that you have a 10% of decline in 21 of the 38 years, or 22 of the 39 if you include 2018 so far. So roughly 1 out of every 2 years, it's reasonable to expect the stock market will drop by about 10%. You see a 15% decline in 13 of the 38 years. That's about 1 in every 3 years. You see a decline of that magnitude. And then what's typically referred to as a bear market decline of 20%, you see that occur 6 separate instances through this 38-year history. So roughly 1 out of every 6 years do you see a decline like that. The point we use this slide to make is that we do know that stocks are one of the, if not the best and most powerful grower of wealth that there is for investors. But that volatility and drawdowns are really the price of admission, and that if you are a long-term investor, if you expect to participate in the gains of the stock market, you do need to go into it eyes wide open with the understanding that 10% declines are quite common, and 15 and 20 even relatively common, but not quite to the same extent. Change topics a bit here and just take a zoom back into the overall bull market run that we've had. And what we just plot here is the S&P 500 index, widely followed index, and show that stocks from their bottom there in March 9, 2009 through the end of the second quarter, up 300+% on a price-only basis. If you were to include the reinvestment of dividends, the index up, as we show on the screen, 389, almost 400%. It's been a 9.5-year bull run or 9 years and 3-month bull run at this juncture from the bottom. This has had a lot of people asking. You see it on the TV, you see it in the newspaper all the time. Where do we go from here? And so the next few slides, we wanted to at least share some of our perspective on the issue and what we think the future may hold based on what we've learned from the empirical evidence. This slide here, many of you are likely familiar with, plots the valuations of the stock market as measured by the Shiller price-to-earnings ratio. So this just plots the price of the S&P 500 index relative to the aggregate earnings of all the companies in the index and the Shiller PE, rather than just plotting it over last year's earnings or forecasted next year earnings. Just takes the average earnings over the last 10 years, the idea being that we could maybe get a slightly smoother relationship rather than one that could be influenced by some variation that it naturally occurs on a quarter-to-quarter, month-to-month basis. And what you see with this slide is, in all these valuation metrics really tell a similar story, but what you see on this particular instance is during this 9.5-year bull market run, valuations have steadily increased. All the way to the right of the slide, you can see the dip down, or that cyclical low in valuations that represented March of 2009, right at the outset of the bull market run. This metric had dropped all the way down to 13.3. In that next 9 years period, valuations have kind of steadily climbed as the market has delivered impressive returns, joined along with impressive profit and earnings growth among these companies. But nevertheless, prices have outstripped the growth in earnings, and you've seen valuations rise to what's definitely characterized as a high level at 32.1 times earnings. And you can see at 32.1, it is a bit above long-term historical averages. So we plot the blue line, the longest vertical line or horizontal line shown across the page. That plots the average over the entire 1900 through June 28 frame. That metric shows valuations at 17 times earnings. If you were to limit your sample to just the last 40 years, though, the average during that time up another 25% to roughly 22. That's the teal bar. And then what if you just looked at the average of the last 25 years? Well, then the average there is about 27, so much kind of closer to where we are. And I also point out that when you look at that 32.1 number, well, historically high and higher than even all these averages we show here, still nowhere near what the extreme bubble-like valuations that prevailed in the later stages of the dot-com bubble in the 99-2000 era. So you saw that in the cycle high there in December of 99 was 44.2. So still another 30% higher from where current levels are. So what does this all mean? This is where we can turn to some evidence and see what does high valuations mean for stock market returns as we go forward. Next slide will help us get there. This slide here just shows that in our perspective, or what the data has told us, is that today's elevated valuations simply suggest that we prepare ourselves for the potential of lower returns in the future. When I say the future, I really mean long-term. Think 5 to 10 plus year horizon, where valuations do start to give you some predictive value. I'll draw your attention to the slide over on the right side of the screen with the green dots, and what we show here, for those not familiar with this type of chart, on each given month, beginning in January 26 all the way running through December 2017, at the beginning of the month, we look at what's that CAPE ratio, the cyclically adjusted or Shiller PE ratio reading, and then we follow the returns ahead over the next 10 months, and we make a plot. And what shows out pretty clearly is that there's a downward relationship here. So if you look all the way to the upper left within that chart, that's periods where you had low initial starting valuations, and they were followed by high subsequent returns. So a lot of those readings in the upper left quadrant of the chart, that would be your late 70s into the early 80s, right before the Reagan and ultimately the Clinton bull market took over. Readings further to the right, when you start having ratios in the 40 range, those were, as we just mentioned, the beginning of the late stages of the dot-com bubble, and we all are familiar with what happened over the next 10 years and what was ultimately referred to as the lost decade. So starting with super high valuations has meant lower returns. As we discussed in the last slide, we currently stand 32 times earnings, so think about right in that 30 range on the chart, and you can see that returns have been certainly lower than average when we started from this period. But what I do want to stress and point out is that while this is a good predictor, it is by no means the end-all, be-all, that there's still a lot of what we describe as noise around this relationship. You can see just at periods with the starting valuation of 30, you've had 10-year annualized returns of about -4 to -5 at the worst. But you've also had some periods where stocks have returned +7, +8+%. annualized over the next decade, even from that same starting level. So it certainly gives us, these high valuations tell us that we should prepare for lower than average returns, but they by no means tell us precisely what returns are going to be. An important other corollary to that is, while valuation is effective for helping us estimate what long-term returns might be, essentially useless when we think about short-term or one-year returns, which is the chart on the left with the blue dots. You can see that first, just take away the order of magnitude on the vertical y-axis is significantly greater on a one-year basis. But even if we just hone in on that 30 times valuation range again, you see you have years when you start in the 30 times earnings ratio, you've had some years as bad as negative 35%. That have followed, but you've also had years as significantly positive as plus 50%. So huge amounts of noise, ton of variation there. Valuations really do not do a good job at giving you guidance on short-term returns, not nearly certainly to the same extent as they do on long-term returns. This slide here, also in relating to where we stand in the current bull market run and what the future may hold. This one comes from JP Morgan. I think it's relevant, and why I wanted to pull it in today's presentation was I've seen a lot of talk in the financial press and in media lately about us being quote-unquote late cycle. Oftentimes the implication is that the strong returns of the bull market are decidedly behind us, and now it's time for investors to begin considering either reducing at least some of their equity allocation or getting out of the markets altogether. JP Morgan's data here, which we plot, shows that that late cycle returns in many instances have historically been quite substantial. So the chart simply plots, or it looks back at the last 8 market peaks we had in the S&P 500, and it looks at the returns in the 2 years leading up to that peak, the 12 months leading up to that peak, 6 months and 3 months, and shows those on the slide. And what you can see, as I said, late cycle returns have been historically pretty substantial. If we look at on average across these past 8 cyclical peaks, in the 2 years leading up to the market peak, you've had a 45% return. On the 1 year leading up to it, 24% on average. Even on the 6 month period, it's been 15% on average. In the 3 month, 8%. So implication of all this is, in my perspective, that an investor, even believing that we are late cycle, getting out too early can certainly result in some missed opportunity. And I'll wrap this up with just one more slide I've borrowed from JP Morgan that I found pretty interesting and wanted to just share with you all. And it provides an interesting or unique kind of alternate perspective on this late cycle issue or theme. So what this slide shows is, again, the S&P 500 index going all the way back to 1900, and it kind of draws that's in the gray lines, and the green lines then represent kind of almost a best fit line along this way. And what the slide does, and JP Morgan's positing out there, is that many people talk about us being late cycle, and that's really when we think about cyclical, the shorter term kind of business and market cycle. But they posit that while cyclically maybe we are late in the cycle, from a secular, very longer term perspective, it's quite possible that we may still be in the early years of such a cycle. I'll go back and you kind of look through the chart here. You've had a couple different instances where you've had a decade plus where the green line is more or less flatlined. Look all the way into 1935, 1939, up into 1950. While we certainly had a decline during the World War II period, it basically flat for a better part of 15 years. Korean War ended, and then we went on this post-war boom that lasted 15 plus years. Then we had another one of the plateauing through the stagflation 70s, and then we jumped into the Reagan era and into the tech boom for another nearly 20-year secular bull market run before we kind of hit the twin peaks of following the dot-com boom and subsequent bust through the early part of 2000s, a good run up through the aughts, ultimately peaking or culminating in the global financial crisis, and now taking 5 years to recover from the losses there. We've reached new highs and continued on, and Yeah, at least this slide suggests that it is still possible. Another perspective that we may be at the beginning stages of a multi decade plus secular bull market run. So that is all of the prepared remarks I had for today. As always, if you have any questions or want to discuss anything covered today or not covered in more detail, please do not hesitate to give us a call or send us an email. I'll also add in a few thank yous. So first and foremost, thanks for taking the time to listen in today. And perhaps even more important is thank you for the trust you place in us every day. We fight hard to earn your trust every day and thoroughly enjoy working with you and partnering with you and look forward to the years ahead. Until next time, thank you.